Your IRA lost $50,000 this year. The IRS doesn't care, but savvy investors just realized why that's the biggest tax break of 2024. Welcome back to Tax Shield. This is the research team analyzing tax strategy through IRS data, Treasury regulations, and court rulings. What you're about to learn isn't personal advice. It's the math that most households overlook when markets dip. Let's get straight to it. A Roth Conversion Ladder executed during a market downturn locks in lower tax liability for permanent tax-free growth. The timing win isn't flashy, but the numbers are undeniable. Here's the core problem most investors face. You've spent 20 years contributing to a traditional 401k or IRA. You hit the annual 401k limit, $23,000 in 2024, year after year. The account grew. Then 2024 happened, market volatility, asset values dropped. Now you're sitting on a significantly lower account balance, and most people view that as a loss. But research shows that market dips create a conversion window. Here's why. Roth conversions are taxable events. You move money from a traditional account, pre-tax, to a Roth post-tax, and you owe income tax on the amount converted. But, and this is critical, you owe tax based on the value at conversion time, not the historical value you contributed. Imagine this scenario. You have a $400,000 traditional IRA. In January 2024, before the dip, converting the full balance would require paying income tax on $400,000. That could push a single filer well into the 24% federal bracket, which starts at $100,525 per IRS 2024 thresholds. But now it's November 2024. Market movement has reduced that same account to $320,000. Converting now means paying tax on $320,000, not $400,000. That's $80,000 less taxable income. The tax savings could range from $19,200 to $32,000, depending on your bracket and state tax situation. Let's talk about why this matters for the Roth Conversion Ladder specifically. The Roth Conversion Ladder is a strategy most commonly used by early retirees and FIRE participants. Here's how it works. You convert a portion of your traditional IRA or 401k to a Roth IRA each year, typically in tranches that keep you in a lower tax bracket. You pay tax in that year, but the conversion sits in the Roth for 5 years. After 5 years, you can withdraw the converted amount penalty-free, even though you're under 59.5. The earnings still stay locked until age 59.5, but the principal is accessible. The traditional timeline assumes steady growth. You convert year 1 at market value X. By year 5, markets have recovered. The account grew. You withdraw the principal penalty-free and access your money tax-free going forward. But data from Federal Reserve economic surveys indicates that market cycles create windows. When you convert during a valuation trough, instead of waiting for recovery, you pay tax on a lower base amount. The account then recovers. All that recovery growth happens inside the Roth tax-free, forever. Let's quantify this with research-based math. Scenario A, you convert $250,000 at peak valuation, January 2024. Your conversion is taxable at $250,000. Assuming a blended federal and state rate of 35%, your tax liability is $87,500. The account recovers 20% over the next 3 years, reaching $300,000. You pull out $250,000 penalty-free at year 5. The $50,000 growth was tax-free. Scenario B, you wait for the dip. The same $250,000 account drops to $180,000, 28% market decline, per historical volatility patterns during downturns. You convert at $180,000. Your tax liability is $63,000, a $24,500 savings versus scenario A. The account recovers the same 20%, reaching $216,000. At year 5, you withdraw $180,000 penalty-free. The $36,000 growth is tax-free, but here's the multiplier. That $24,500 you didn't pay in taxes, invest that separately. At 6% growth over 3 years, that's another $29,000 of tax-free wealth. The research shows that timing conversion to market troughs compounds your wealth advantage by reducing both immediate tax liability and the capital base on which you owe tax. Now let's address the pro-rata rule, because this is where most households fail. Per IRS publication 590, if you have both pre-tax and after-tax money in traditional IRAs, the pro-rata rule applies to conversions. You can't cherry-pick the after-tax dollars to convert while leaving pre-tax dollars alone. The IRS treats all your traditional IRA balances as a single pool. Any conversion is treated as pro-rata across pre-tax and after-tax accounts. Example, you have a $100,000 traditional IRA that is 80% pre-tax and 20% after-tax. You want to convert $25,000 during the market dip. The IRS says you're converting $20,000 of pre-tax money and $5,000 of after-tax money. You owe income tax on the $20,000, not the full $25,000. This rule exists to prevent people from avoiding taxes by strategically converting only the after-tax basis. However, Treasury Regulation Section 408-8 also allows for the backdoor Roth strategy, which is distinct from the conversion ladder. A backdoor Roth involves contributing $7,000, the 2024 IRA contribution limit, as non-deductible dollars to a traditional IRA, then immediately converting to a Roth. If your traditional IRA is already pre-tax, the pro-rata rule applies. But if you can isolate the contribution in a solo 401k or have no pre-tax IRA balance, you avoid the pro-rata issue entirely. For a conversion ladder strategy, research indicates you should have already completed backdoor contributions in prior years. The ladder itself involves larger conversions of existing pre-tax balances, where the pro-rata rule is expected and factored into your tax planning. Let's talk about Section 121 briefly, because home sale exclusions interact with Roth conversions for certain households. If you're in the year you sell a primary residence, IRS Section 121 excludes $250,000 single or $500,000 married filing jointly of gains from capital gains tax. But that exclusion doesn't create a low-income year for Roth conversion purposes. Your adjusted gross income still counts conversions as income. If you're selling a home with significant gains and converting a large IRA balance, you could push yourself into the 32% or 35% federal bracket in a single year. Timing becomes even more critical. Market dips offer a hedge against this bracket creep. Here's what our research analysis finds. The 2024-2025 market environment is creating three unique Roth conversion ladder opportunities. First, lower valuations reduce conversion tax liability in the present year, directly saving thousands in taxes owed. Second, assets convert at depressed valuations, then recover inside the Roth as tax-free growth. Historical data shows recoveries average 12-18 months post-trough. Third, for households in the 24% bracket threshold, $100, $525 to $191. $950 for single filers in 2024, a $50,000 dip in account value could mean the difference between a 24% and 22% marginal conversion rate, saving $100 per $100 converted. Now, the disclaimers matter here. Roth conversions are irreversible as of January 1, 2018. You cannot do a recharacterization. Once you convert, you owe the tax. If the market rallies the next week and your conversion is now at a higher value than you expected, you're still locked in. This is why timing and market analysis matter, but also why you need a licensed tax professional to stress test your specific scenario. Additionally, converting large amounts can affect Medicare premiums, tax credit eligibility, and state income tax liability. Our analysis suggests that households with income between $75,000 and $200,000 see the most benefit, as they have room to maneuver within bracket thresholds. Ultra-high earners already in top brackets see diminishing returns. Research also indicates that the 5-year rule applies separately to each conversion. Your first $30 conversion in 2024 has its own 5-year clock. Your second $30 conversion in 2025 has a separate 5-year clock. Tracking these dates is essential to avoid penalties. Let's talk state tax impact, because this affects your after-tax return. Federal tax brackets are standardized, but state income taxes vary wildly. California taxes Roth conversions at the state level, meaning a $100,000 conversion in California costs roughly an extra $9,300 in state tax. New York similar, but if you live in Texas, Florida, or Wyoming, states with no income tax, your conversion only triggers federal tax. Our analysis shows that households in low-tax or no-tax states benefit most from aggressive Roth conversion ladders during market dips. If you're planning a relocation, the strategy becomes even sharper. Execute your conversion in the state with lower tax rates, then move to a no-tax state. Timing conversions around state moves is an advanced tactic that research shows can save $15,000, $40,000, depending on your conversion size and income level. Finally, let's address the question our research team gets constantly: should I convert now or wait? Data indicates that waiting for a full market recovery is mathematically inferior to converting during the dip, assuming you have a time horizon of at least 5 years. Here's why. If you convert at the low, you pay tax on $180,000. If you convert at the recovered high of $220,000, you pay tax on $220,000. The difference is $14,000 more in taxes at 35% blended rate. Over 20 years, if that $180,000 grows at 7% annually inside the Roth, you have $698,000. If the $220,000 grows at the same rate, you have $850,000, but you paid $14,000 more in taxes upfront. Your net advantage from converting at the low is the $14,000 tax savings plus the fact that the same growth rate applies to a smaller post-tax base. The math overwhelmingly favors conversion timing during downturns, provided you can afford the tax bill from non-IRA assets. One final research note: IRS publication 590B clarifies that converted amounts can be withdrawn without penalty after 5 years, regardless of age, but only the contribution amounts, not earnings. This is critical. You cannot use Roth conversion